chocolate giant Barry Callebaut has been one of the most consistent names in the food industry, but lately, the market has been losing its sweet tooth. Welcome to Insightful Value, where we break down undervalued and misunderstood companies that most investors overlook. Today, we're diving into what's really behind Barry Callebaut's recent stock decline and whether there's hidden value beneath the surface. This review is for informational and educational purposes only and does not constitute financial advice. Barry Callebaut is the world's leading manufacturer of high-quality chocolate and cocoa products. Headquartered in Switzerland, the company supplies major brands like Nestlé, Mondelez, and Unilever, and it operates in over 40 countries. It's the engine behind many of the chocolate products consumers love, but you don't see its brand on the shelves because Barry Callebaut works mainly B2B, operating behind the scenes. So why is a dominant player in a recession-resistant industry struggling in the stock market? There are a few reasons. First, rising cocoa prices have squeezed margins. Cocoa prices recently hit multi-decade highs due to supply issues in West Africa, caused by extreme weather and disease outbreaks in cocoa plants. Since Barry Callebaut relies heavily on sourcing raw cocoa, cost inflation is a serious headwind. Add to that currency fluctuations, especially the strength of the Swiss franc, which puts further pressure on earnings when international revenue is converted back. Then there's the impact of temporary plant closures due to quality control issues, like the salmonella contamination incident in 2022, which led to halted production at its largest facility. While the company resolved the issue, the event highlighted potential operational risks. From a financial perspective, Barry Callebaut remains a strong cash-generating business. It boasts stable revenue growth and a resilient global footprint. However, the most recent earnings reports show flat to declining operating income and a cautious forward outlook. Dividend-wise, it continues to offer modest payouts, but investors are starting to question the near-term growth story. So what does this mean for value investors? On a discounted cash flow basis, the stock may appear undervalued when factoring in the company's long-term contracts, innovation in sugar-reduced and plant-based chocolate, and steady global demand. However, the short-term risks, from commodity prices to consumer behavior, are clearly weighing on sentiment. The current price dip could be a setup for long-term buyers, but only if you're prepared to ride out some near-term volatility. At Insightful Value, we specialize in analyzing companies just like Barry Callebaut, businesses that may be facing temporary setbacks but offer real potential for patient investors. We break down the key data, explain the trends, and provide context that goes beyond the headlines. Whether you're a pro or just getting started, our content is built to make financial insight more accessible. If you're curious about more hidden opportunities in the market, head over to InsightfulValue.com, and don't forget to subscribe to our channel for weekly breakdowns on undervalued companies around the world. Thanks for watching. See you in the next one.